Well, hello everyone, and welcome to another episode of
Startup Chat.
I'm Afshindus.
I'm Mo.
Hi Mo.
Hey.
I know what I want to talk about this time.
Okay.
It is a question on everybody's mind.
Mm-hmm.
How much is my company worth? So that's a valid question, right? Because when you go out there and you want to raise funds, you say, what am I buying into, right? So any ideas on how we approach that conversation?
I think if someone asks you this question, you should say now or now. Because
that's a good one. Now or now?
Now, yeah.
So
totally different.
Yeah, so the price keeps going up or down depending on how you achieve. Well, that's of course an exaggeration, but come back in 3 weeks and see how much traction we've got by then, and we'll talk then.
Mm-hmm.
And I think that's a very valid point, because some investors say, I'm interested to invest, but I'm going to watch you for 6 months and see how well you do. And so the now or now for an investor becomes a valid question, right? Now or now. Say, okay, now.
And the difference is huge.
Yeah, the difference could be huge, and it could validate that, yes, you can perform. And maybe the valuation you're just throwing out there is something that they should believe in and they should invest in, right? So that was good. But going back to the question, how do you put a valuation on a company? What are your thoughts?
Depends on your traction, I believe.
Okay.
And depends on your service you are providing for the customers.
Okay.
So I have this product preparing for a huge market. Yes. I'm going to take 1% of this huge market. Mm-hmm. So I believe I can make that much.
Okay.
And based on that, I believe my company valuation is this. It's the simplest and most dumb way to talk about valuation.
Now, do you think that's a valid way to present it? And how true could that be?
I think it's not. Okay. And I remember one time you were talking about the discount model.
Oh, yeah.
How you value a company.
Yes.
I think this is one of the greatest examples. And if you like, you can share with us how we can do that.
Sure. Before we do that, I want to give you two things to think about. One, companies that have really gone up in value and then crashed and burned. like Terranos by Elizabeth Holmes. Like, it was into the billions, and then she ended up in prison, and there was no IP that lied about it, and all those billions of dollars went to dust. Another one that still is persisting and existing is WeWork. It went all the way up. Really intelligent people invested in it, billions of dollars.
Yes.
SoftBank was in there, and all of a sudden it dived all the way down. So my take on valuations is it's in the eye of the beholder.
Okay, interesting.
So you could come out and say, I'm worth $1 million, or I'm worth $10 billion. Are there any customers out there who are going to buy your word and invest based on what you're telling them? If they are, they're going to validate what you're worth. But if there aren't, then no, you're not worth that, because the market isn't buying into what you're saying, right? So before you start actually becoming profitable, because profit and revenue are two different things, right? So before you start being profitable and before you start paying dividends to your shareholders, anything you talk about valuation, you have to do with a grain of salt. Because you can value your assets. You can try to value your intellectual property. You can try to value the traction and the growth you've created, and you can try to create a discounted cash flow model, which says, I'll be worth this much in the future, but I'm here now, so if you want a piece of this pie and you want to come in today, I'm going to give you a discount annually, and I'm going to have a multiple of what multiple of my revenue is going to be my worth, And if you agree with that multiple, and if you agree with that discount, then I should be worth this much today. But that's only one way to look at things, right? You can throw a dart and hope it hits the bullseye, but chances are you have a moving target that you're working with, right?
Yeah.
And that moving target is the markets, it's the liquidity in the markets, it is where you're located, who your founders are, who's the team, how hot is the subject that you're going out there into the market with, right?
Let me ask you a question, Rahan.
Yes.
First time when a startup going to fundraise,
yes,
the valuation is the hardest.
Yes.
And I know it's friends and family around, and it's not that important when we are talking about valuation.
Yes.
But it's a question.
Yes.
When you are giving shares or doing a safe contract,
yes,
I don't know, whatever the way is.
Yeah.
How do you want to value on the first day?
Very good question. So it's a leap of faith. So anybody who invests the first few checks into a startup, they're actually putting their beliefs into this, and they're believing the founders are genuinely able and capable of delivering and executing. They're believing that yes, there's a market for this. They're believing that yes, there's capability to pull it off. And they're excited about the prospect of growth. And so they'll come in and they'll write a check. Now, what value do you put in front of them? I believe one way to look at this is first have a roadmap and say, I need enough money to go from where I am to where I want to get. And that roadmap should be at the most maybe 18 to 24 months, maybe 12 months at the beginning, right? 12 to 24 months max. That's what I think the roadmap should be, that you present
product and solution.
Of course, like, if we are talking about drug development, that could be 10 years.
Yeah.
Right? But most of the typical techs that you develop, you could try to predict 12 to 24 months. You'd have a lot of traction. Even with pharmaceutical companies, you can create that projection for traction within 24 months, right? And then you look at how much money you need to get there. And then you look at how reasonable is it to dilute yourself a certain amount in order to raise the money to get where you want to go. So if you say, I only need $500,000 to get there, and that's what I'm going to ask for, the investors might come out and say, well, this is your first raise. We want to have a 20% stake in the company, a 25% stake in the company. And so let's value at 2 million, 2.5 million, whatever, and then we'll bring in the 500K and we get the ball rolling. But if you say, I want $2 million, and you can justify it's required for you to have $2 million to achieve that first big milestone, the investor might say, okay, well, with $2 million, we don't trust you yet to give you that much money. Let's do a smaller raise, a smaller milestone, dilute you less, and then lower valuation. And then once you prove you can do that, let's go raise you another million, 2 million, whatever you need with a higher valuation. And then the question becomes, how much dilution should happen at that stage, right? I want to name a person here. Okay. You usually don't name anyone. But there's a person, and if you're seeing this, I absolutely look up to you. His name is Mark Friend.
Okay.
He's
a friend?
No, the last name is Friend.
Okay.
Frind, and he has the Friend Winery.
Okay.
Mark graduated from BCIT and started a company called Plenty of Fish.
Okay. Is it?
It's a dating app. Yeah.
Okay.
And I think Match.com bought it from Mike for around, I don't know, $750 million.
Wow.
And Mark sat in his room and developed that app alone, all by himself, until it was extremely profitable before he brought in the first employee.
Wow.
So those are the exceptions, right? And then there are companies like Terranos that went out there and raised billions of dollars and crashed and burned. So let's look at those two extremes. Let's look at something in between, right? When you look at in between, then the question becomes, okay, I'm here. I want to get here. I need help. I need resources. I need other people to come in and engage. and I need money as one of my resources. How much money do I need? You say, I need $1.5 million. And the investors come in and say, yep, that makes sense. For what you're doing, $1.5 million is a reasonable amount to raise. And then you'd ask the investors, well, how much of my company should I give up for that? And if you have really smart investors, they don't ask you to give up half your company for that, because they know that you'd be demotivated. You need to have your employee stock option plan. You need to have the founder's shares, and you need to dilute yourself further as you go forward and raise more, right? So if they come on and say, okay, I'll give you $1.5 million and I want half your company, they're actually acting counterproductive to their own interests. So then they try to hit it in a limit that would make sense to everybody and maximize what they get out of it, right? So they might come out and say, okay, for $1.5 million, I want 20% of your company. And you can work that out to what your valuation would be, right? $7.5 million, 1.5 coming in. But then there's the other thing you need to look at is your valuation pre-money or post-money.
Oh, yeah.
So are you saying I'm worth $10 million before the money comes in, and if I raise $3 million on 10, then I'll be worth 13 million, and then I've given up 3 out of 13, that percentage of my company? Or am I worth $10 million post money? That means you want to raise $3 million and you're at 7 million right now. So the 3 million that comes in actually owns 30% of your company. So that's another way to look at things. Is it a price round? Is it a safe? Is it a convertible note? What is the valuation? Now, since we're talking about valuation, in Silicon Valley, they came up with the idea of a simple agreement for future equity. And so that kind of eases the conversation around valuations, because it says to you, I don't know what I'm worth today. And you probably don't know what I'm worth today either. So you give me $2 million or whatever you want to raise. Let me execute on my plan. And whatever my value is going to be once I've executed and I've brought in some real cash at that value, I'll give you a discount on that.
Okay.
But I'll also put a cap on it. So if my value is going to be $200 million and you came in day one, I'm not going to give you a discount on 200 million. Like, my cap is going to be $20 million.
Okay.
Right?
Yes.
So you put a cap on it, you put a discount on it, you issue a simple agreement for future equity, and you kind of tap dance around the valuation rather than pinpoint the valuation to an exact number.
Okay.
And that has worked wonders for some companies. And
lots of companies use that model at the beginning.
They do. Yeah, but there are inherent risks with that.
What are they?
I'm not a legal advisor, so I don't want to dig deep into the risk. But there's some performance criteria. What if they're not met? What if something happens along the way? Or the fact that you're not on the cap table. Because if you're safe, you say, I have $1 million in safe. But how many shares have I issued on it? I don't know. We'll find out later, right? So there are a lot of things to consider for both investors and the ones who are raising with a safe. It's proven to be a very valid way to raise when your valuation comes under question at the very early stages or even later on. I'm a big fan of pricing things out. Everybody knows what they're getting day one, right? And so far, knock on wood, I haven't had any problems while I price shares out, because I lead. If I want to invest somewhere, I'll put in my own money, and then I'll tell others, hey, if you want to put in money, I've put in my own money, come and put in the money, right? And so when they see that, yes, you're treating yourself the same way you're treating them, it kind of gives them a bit of confidence on, maybe this is real. But there's a big leap of faith that needs to happen anytime you're putting a value on a startup at very early stages. And that leap of faith could prove to be amazing or maybe a disappointment down the road. Hopefully, there's going to be more amazing stuff rather than disappointment.
So it is important to, after you're talking with your friends and family, next investor should be a professional one. Not those that can kill the company at the very beginning days.
Yeah, I think angel investors, after friends, family, associates, and business associates, angel investors are the next round, and they're super angels. And then if you're lucky, you might get somebody who can invest and at the same time contribute.
Yes, that's the
And
best case
I know you've
scenario.
had that happen to you, right?
Yeah, a couple of them.
Okay.
Yeah, I was so lucky to have those people who really liked us and invest and start working with us.
Yeah, that's the ideal way to get investment, right? Smart money is what they call it.
Exactly.
People can actually contribute to that bigger picture while bringing in the resources that you need to get things done.
And they bring other people that can do great job like them.
Yeah, they become advocates for you.
Exactly.
Yeah. So we could talk about this forever, but I think, well, how long have we been talking? Oh, about 16 minutes. Nice. Okay, well, let's call it a wrap if you're okay. Thank you, everybody, for watching, for listening to us. And we would love you to like us and subscribe if you wish. And we look forward to getting your comments and any questions you might have that we might be able to chat about. Once again, there's nothing scientific about what we talk about. We might throw in a few ideas here and there, and it's just our own experiences that we're sharing with you. So thank you once again. Have a great day.
Thank you. See you.